Welcome to the Deep Dive. Today, we're pulling back the curtain on a company you might not know by name, but whose quiet presence is absolutely essential to the future of science and medicine. We're talking about Thermo Fisher Scientific. Think of them as the vital picks and shovels provider for, well, humanity's biggest scientific breakthroughs. Our mission today is to go beyond the headlines, really, and extract the most important insights from a comprehensive investment analysis on Thermo Fisher Scientific, ticker TMO. We're going to uncover their competitive fortress, their leadership, their financial health, and, what the future might truly hold. This isn't just about investing. It's really about understanding how innovation happens right beneath our noses.
Exactly. And for this deep dive, we've basically distilled an in-depth memorandum that thoroughly analyzes Thermo Fisher Scientific. It covers everything from their unique business model and formidable competitive advantages, right through to their management strategy and financial performance. Crucially, we even dig into the often overlooked aspects like customer and employee sentiment. Our goal is to take all this complex information and sort of turn it into clear, actionable insights for you.
Okay, let's unpack this then. Thermo Fisher is often described as the picks and shovels provider for the modern life sciences gold rush. What does that truly mean for their business model? How does that actually work?
Well, it's an elegantly simple model at its core, actually. They supply the essential tools, the consumables, the services needed for scientific research and development. This allows them to profit from the aggregate activity of scientific progress without having to bear the high-stakes risk of any single drug or research project succeeding or failing. They make money as long as science is being done, which gives them remarkable resilience.
That's a powerful position. So they're effectively providing the infrastructure. Tell us about the four synergistic segments that make up this empire. How do they fit together?
Right. They operate through four key segments, and each plays a crucial role. First, there's Life Sciences Solutions. This segment provides the very building blocks, the foundational technologies for pretty much all modern biological research. Think reagents, instruments, consumables for things like genomic analysis, protein analysis, cell analysis, basically analyzing DNA, proteins, and how cells work. They're indispensable at the earliest stages of, almost every breakthrough, with industry-leading brands like Applied Biosystems and Invitrogen.
Okay, the foundational stuff.
Then second, we have analytical instruments. These are the high-tech razors, if you will, of the scientific world. Things like mass spectrometers, which precisely measure the mass of molecules, and electron microscopes for, ultrafine imaging. All under the Thermo Scientific brand. And crucially, these instruments create long-term, sticky demand for the company's proprietary consumables. That's key.
The classic razor and blade model.
Exactly. Third is Specialty Diagnostics. This offers a wide range of diagnostic test kits, reagents, instruments. These are what hospitals and clinical labs use to diagnose diseases, monitor patients, and, ensure health outcomes.
Mm-hmm.
And finally, their largest segment, Laboratory Products and Biopharma Services. This is huge.
Sure.
It includes the massive Fisher Scientific channel, which is essentially a scientific marketplace offering over, 2.5 million products. It also houses Unity Lab services for equipment support and, very importantly, large contract development and manufacturing, or CDMO services. So they actually make drugs for other companies. And also Clinical Research Organization, CRO, services running clinical trials for others through its Patheon and PPD brands.
Yeah, okay. It's clear they touch almost every part of the scientific process. So how does this diverse mix translate into their revenue? I've heard something about a highly predictable financial profile. Is that really the case?
It truly is. Approximately 83% of their revenue is recurring. This comes from consumables and services that are consistently reordered, almost like a subscription, Only about 17% comes from those one-time instrument sales. This structure ensures they generate revenue as long as scientific research is ongoing, making their financial profile exceptionally stable.
Yeah. So it's not just simple. It sounds incredibly enduring. The report even calls it a bet on human progress. What are the powerful underlying mega trends that are really going to propel this business forward for the next, say, decade or two?
Well, it's driven by some really powerful, almost irreversible trends. Think about an aging global population, the increasing prevalence of chronic diseases, robust R&D funding that's a market estimated at $235 billion and growing at maybe 4-6% annually, and the significant shift towards complex biologics medicines derived from living organisms plus cell therapies and personalized medicine tailored to individuals. These forces create a fundamental demand for more of exactly what Thermo Fisher provides. It's a strong tailwind.
Right. And from a customer perspective, with all these options out there, why do scientists and labs consistently stick with Thermo Fisher? What keeps them locked in?
Well, scientists prioritize reliability, consistency, and efficiency above almost everything else. Once a research workflow is established, and crucially, validated using Thermo Fisher's products, the operational friction and the sheer risk involved in switching to a new supplier are substantial. It's like a key piece in a very complex machine. Changing even one reagent might mean completely revalidating the entire process.
Which sounds incredibly costly and time-consuming.
Exactly. It risks data integrity and can delay projects for months, even years. This reinforces that long-term demand. Plus, through their service arms like Unity Lab Services, PPD, and Patheon, the company becomes deeply embedded in how their customers operate day to day. They function less like just a product vendor and more like an indispensable infrastructure asset, a utility almost for the life sciences industry. Their offerings basically become a non-discretionary operating expense for customers. That makes their revenue streams incredibly resilient.
Okay, so given all this, what does it really mean for their competitive position? The analysis talks about a wide economic moat. What's the secret sauce here? What keeps competitors out?
Yeah, the primary moat source is a really formidable combination of, one, prohibitively high switching costs, and two, overwhelming economies of scale. Morningstar actually rates it as wide, which is, their highest designation for competitive advantage.
Okay, tell us more about these switching costs. I'm picturing something like being locked into your phone charger, but maybe on a much bigger scale.
It's kind of like that, but twofold, really. First, there's that classic razor and blade model we touched on. They sell a high-value instrument, the razor, which effectively locks you into buying multi-year streams of their proprietary high-margin consumables to bend blades.
Mm-hmm.
These consumables are absolutely critical, but often they're a small part of a lab's overall budget, which gives Thermo Fisher significant pricing power without setting off major budget alarms. Well, effective. Second, and arguably more powerfully, is that workflow integration. Their products become integral parts of complex, validated scientific workflows. As we discussed, changing even a single component, like a reagent, can mean a complete, costly revalidation of the whole experimental process. That introduces huge risks to data integrity and project timelines. So switching suppliers becomes this really daunting operational burden for the labs.
That sounds like an absolute nightmare for a lab manager. Can you walk us through a concrete example? How does this moat play out in the real world?
Sure, absolutely. Let's imagine a university proteomics lab. So a lab studying proteins on a large scale. They invest in, say, Thermo Scientific Orbitrap Astral Mass Spectrometer. That's a major capital investment up front.
Big bucks.
Right. And researchers get trained on their specific hardware and their proprietary software, like Chromeleon. That creates initial stickiness right there. Then, to operate that machine, the lab must continuously buy Thermo Fisher branded consumables, specific columns, reagents, calibration standards, using third-party stuff. Not really an option. It could void warranties, or worse, produce unreliable data, which jeopardizes grants, publications, everything.
So they're really tied in.
Deeply. And then, as their discoveries maybe progress towards clinical application, they might even engage Thermo Fisher's PPD division for clinical trial services. This just further entrenches Thermo Fisher across their entire value chain. Now, imagine a competitor like Agilent or Waters trying to displace them. It's an immense challenge. They need to offer a demonstrably superior instrument and convince the lab to ditch years of expertise, validated workflows, historical data. The financial, operational, and scientific risks of making that switch are just huge. It effectively repels competitors.
That paints a very clear picture. Is this moat static, though, or is it actually getting stronger over time?
The evidence strongly suggests it's actively widening. Their aggressive and strategic M&A activity is a primary driver here. Acquisitions like Patheon for CDMO, PPD for CRO services, the binding site in specialty diagnostics, Olink in proteomics, these weren't just about adding revenue. They were really calculated moves to deepen customer integration across the entire R&D lifecycle. This one-stop shop capability becomes nearly impossible for smaller, more specialized competitors to replicate.
Mm-hmm.
And, their sheer scale, over $40 billion in annual revenue, investing over $1.4 billion a year in R&D, allows them to simply outinvest peers. Plus, maintaining that global supply chain is a significant barrier to entry in itself. Their explicit corporate strategy. Yep. Increase wallet share with existing customers. That really proves this widening moat thesis.
Okay, we've talked a lot about the structural advantages, the business model, the moat, but let's shift gears a bit to the human element. What do customers and employees actually say about working with or for Thermo Fisher? This kind of Scuttlebutt often reveals the true culture beneath the surface, right?
Yeah, and what's fascinating here, is that while Thermo Fisher's official mission is all about enabling customer success, when you look at places like Reddit forums, where scientists and lab techs speak candidly, you find a relationship built much more on necessity than, let's say, affection.
Okay, so not exactly customer love.
Okay.
What are the common gripes? What do you hear?
Well, common complaints often revolve around severe logistical problems and back orders. Imagine having a critical experiment on hold, costing thousands in grant money because you're, quote, waiting 3 weeks for routine consumables. That's unacceptable for them.
Ouch.
Yeah. You also hear about issues with inconsistent product quality sometimes, poor customer service experiences, and just a general sense of being captive to this dominant player. The Better Business Bureau rating is even poor, citing a failure to respond to multiple customer complaints. That's telling.
That's definitely a different side of the coin. What about the view from inside? How do employees, the people living this culture daily, view this corporate giant?
Employee review sites, places like Glassdoor, they show this kind of dual nature. On one hand, you see praise for the mission-driven work, the stability of the company, and actually a genuine customer-centric focus, at least at the strategic level. But on the other hand, it's frequently described as, very corporate, bureaucratic, a place where things tend to move fairly slowly. Criticisms often point to a very hierarchical structure, slow career advancement, and real challenges in integrating the dozens, maybe hundreds of companies they've acquired. This can lead to a feeling of working within disconnected silos, not one cohesive unit.
This raises a really important question then. Could this immense competitive strength, this moat, actually be creating a form of cultural debt?
That's exactly the term the analysis uses, and it's a powerful idea. The very fact that they can thrive despite these documented issues with logistics, service, quality, it's a testament to their powerful competitive position, right?
Sure.
But this dynamic creates this cultural debt, like a hidden liability accumulating off the balance sheet. A business that isn't, maniacally focused on delighting its customers and one suffering from internal bureaucratic friction is building up a long-term vulnerability. Over a multi-decade investment horizon, this accumulated friction, this debt, could provide the very opening that a well-funded, customer-obsessed competitor needs to start chipping away at that fortress. Maybe one disgruntled lab at a time. It represents a significant, though maybe slow-moving, qualitative long-term risk.
Okay, let's pivot now to leadership. Because even a superior business can be run into the ground by subpar management. What about Mark Casper, the CEO?
Right. Mark N. Casper. He's provided over 15 years of stable and pretty consistent leadership, serving as CEO since 2009. His operating philosophy seems very clear. It's centered on that company mission to enable our customers to make the world healthier, cleaner, and safer. He's also a big proponent of continuous improvement through their internal system, the Practical Process Improvement, or PPI business system, and he demonstrates a clear, long-term, owner-oriented mindset. He even has performance-based stock units designed to keep him incentivized and leading through 2030.
Okay, stable leadership. How has this translated into their capital allocation strategy? How do they decide where to put their money?
Well, Morningstar gives them high marks here, too, an exemplary rating for capital allocation. Their framework clearly prioritizes strategic M&A mergers and acquisitions, allocating about 60-75% of their capital deployment to it. But they also consistently fund internal growth and shareholder returns. They invest heavily in their future, with annual R&D spending around $1.4 to $1.5 billion. And they've also committed another, I think it's $2 billion, towards boosting their U.S. manufacturing and R&D capabilities over the next few years.
And what about the acquisitions themselves? They seem absolutely core to their growth story. Are they proving successful? Are they integrating well?
Acquisitions are definitely their primary use of capital. They've deployed over $30 billion since 2010 alone. The strategy appears disciplined, generally focusing on acquiring companies that strengthen their customer value proposition and enhance their strategic position, not just buying revenue. For example, that huge $20.4 billion PPD acquisition. It established Thermo Fisher as a leader in clinical research services and is reportedly on track to exceed its synergy targets. More recent deals like the Binding Site and Olink strategically bolster their presence in high-growth fields like specialty diagnostics and proteomics. They also maintain a balanced approach to returning capital to shareholders, including about $4.6 billion planned for 2024 through share buybacks and dividends.
So with all these advantages, the model, the moat, the leadership, one would expect Pretty solid financials. Let's dig into the numbers. What do they reveal? Are they healthy?
Yeah, they've really proven to be a highly reliable earnings machine over the years. Their financial history shows a consistent and, frankly, impressive upward trend in revenue and profits. The main exception being the predictable normalization after the huge COVID-19 pandemic peak, where they played a big role. They've shown remarkable resilience through various economic cycles, too.
Okay, what about key metrics?
Right, looking at key quality ratios, their return on invested capital, ROIC, basically how efficiently they use their money consistently, generates returns well above their estimated cost of capital, or WACC, which is around 8.7%, even after that big PPD deal.
That's good.
Very good. Their free cash flow, the actual cash that the business generates after expenses and investments, compared to their net income. That conversion is exceptionally strong, consistently near or even above 100%. That indicates really excellent management of working capital and their leverage. Net debt to EBITDA is running around 2.5x. That's generally seen as prudent and quite manageable for an investment-grade company like them. Gives them plenty of flexibility for future moves.
Okay, solid financials. Now for the million-dollar question, maybe billion-dollar question. What about the valuation? Is it a good time to actually acquire a piece of this company, or has the market already priced in all this quality?
Right. The bottom line. The current valuation multiples are running roughly 23 to 24 times price to earnings, PE, so share price versus earnings per share, and around 22 to 23 times price to free cash flow, PFCF.
Okay, and how does that compare historically for them?
Well, that's what's potentially compelling. Their 5-year historical averages are significantly higher. We're talking around 32 to 33 times PE and 30 to 31 times PFCF.
Wow, so it's trading at a pretty notable discount to its own history then.
Yes, quite notably. Roughly a 26 to 28% discount, depending on the exact metric and time frame. The analysis suggests this represents a fair to perhaps attractive entry point for a long-term owner. The argument is the fundamental quality of the business has arguably improved with recent acquisitions, yet the market seems disproportionately focused on temporary headwinds. Things like that post-COVID normalization and a cyclical inventory destocking currently happening in the biopharma sector. This creates a potential window, an opportunity for patient capital.
Okay, looking ahead then, what's the biggest growth engine for Thermo Fisher going forward? Where will the real expansion come from in the next 5-10 years?
The primary growth engine, it seems, is the secular trend, meaning long-term, non-cyclical of pharmaceutical and biotech companies outsourcing larger and larger portions of their R&D, their clinical trials, and their manufacturing. The increasing complexity and cost of developing novel therapies, especially in these fast-growing areas like biologics and cell and gene therapy, it makes Thermo Fisher's integrated end-to-end service offering, particularly through PPD and Patheon, increasingly indispensable. They become a crucial partner.
Makes sense. Now, beyond the day-to-day fluctuations, what are the biggest, maybe existential long-term risks? The things that could truly damage or permanently weaken this company?
Yeah, you always have to consider the downside. There are a few key ones outlined. First, value-destructive M&A. Their growth relies so heavily on these large acquisitions. A major error, like overpaying massively or completely failing to integrate a large asset, could destroy a significant shareholder value.
Right. Integration risk is huge.
Huge. Second, that erosion of their trusted partner status. The customer friction, the cultural issues we talked about.
Yeah.
That's a serious, even if slow-moving, long-term risk. If they consistently frustrate their users, eventually you can invite more focused, customer-centric competition to gain a foothold. And third, a structural shift in R&D. Now, this is probably a lower probability event, but you have to consider it. A fundamental change like drastic cuts in government research funding globally, or maybe a new, less capital-intensive research model emerging, perhaps AI-driven drug discovery, significantly reducing physical lab work. That kind of shift could diminish the long-term demand for their core products and services.
Okay, some significant risks to watch. Finally, let's really try some second level thinking here. What's the general market consensus, the sort of Wall Street view on Thermo Fisher right now? And more importantly, what's the compelling contrarian view that the market might be missing?
Okay. The prevailing Wall Street narrative is pretty straightforward. Thermo Fisher is seen as a best-in-class, blue-chip compounder, a high-quality company. They acknowledge it's navigating some temporary headwinds right now, that post-COVID normalization, the biopharma inventory cycle we mentioned. But the analyst consensus is overwhelmingly positive. Lots of buy or strong buy ratings. They expect growth to reaccelerate, probably starting in 2025. And they generally view the stock's current valuation, that discount to history, as an attractive entry point ahead of this anticipated recovery. That's the standard view.
Okay, that's the consensus. But you mentioned a contrarian view, something deeper the market might be overlooking.
Yes. The analysis posits that the market is potentially underestimating the long-term risk posed by that cultural debt we discussed. The debt being accumulated through, well, suboptimal customer service, logistical frustrations, and maybe internal bureaucracy. The market tends to focus primarily on quantifiable metrics, things you can plug into a spreadsheet easily. But the Scuttlebutt, the qualitative analysis, uncovers this problem that doesn't appear neatly on a balance sheet.
Which is
Widespread frustration among the company's actual end users and even employees. The consensus view implicitly assumes the moat is just so strong that customers basically have no alternative. They have to stick with Thermo Fisher. The deeper second-level question is, okay, but for how long can that really last? A company marketing itself as a trusted partner can't consistently frustrate its partners without some eventual consequences.
Right. And could it be worse? What if this internal friction, combined with the relentless acquisition strategy, is actually making the moat more brittle rather than stronger? Could that be happening?
That's the core of the red team challenge in the analysis. It's asking precisely that. What if, by acquiring dozens, maybe hundreds of disparate companies, Thermo Fisher has unintentionally become this vast, siloed bureaucracy, a place where the innovative, maybe more customer-centric cultures of the companies it acquired get stifled by corporate processes, by complexity. In this view, product innovation could actually slow down. Customer service deteriorates, as evidenced by some of those user complaints we found. And those touted synergies from M&A, maybe they're just aggressive cost-cutting initiatives that actually hollow out the acquired businesses and end up alienating their core customer base over time.
So what's the potential outcome there?
Well, this scenario creates a massive long-term opportunity for a more focused competitor, perhaps a rival like Danaher, or maybe even a new player backed by private equity. They could execute a focus and win strategy, targeting specific high-value categories where Thermo Fisher might be weak or frustrating customers. Over a decade, you could see Thermo Fisher losing market share on multiple fronts to more agile, more customer-focused competitors. The one-stop shop could devolve into a master of none. And in that scenario, the company's formidable pricing power would erode. Margins would compress. Return on invested capital could fall below its cost of capital. The stock would likely derate permanently. And what looked like a wonderful company at a fair price today could, over the long haul, be revealed as something more like a slowly melting ice cube. This represents arguably the most compelling reason why an investment today, based just on the current numbers and consensus, could become a major long-term mistake. It's that hidden risk.
What a journey through the really intricate world of Thermo Fisher Scientific. We've seen a company that's clearly indispensable to global science, protected by what looks like a widening moat and led by disciplined management. But we've also uncovered these potential long-term vulnerabilities hidden just beneath the surface, like this concept of cultural debt that could really challenge its trusted partner status down the road.
It truly highlights that even the most formidable seeming businesses have these complex internal dynamics, things that can really impact their long-term trajectory. And understanding these nuances, going beyond just the balance sheet and the income statement, is absolutely critical for long-term assessment.
So for you, our listener, as you think about the companies that quietly underpin so much of our world, maybe here's a final thought to chew on. How much cultural debt can any company accumulate before its seemingly impenetrable fortress actually begins to show cracks? And what does that possibility mean for how you assess value, not just in the numbers, but in the human elements of a business? That's our deep dive into Thermo Fisher Scientific. We hope this has given you a shortcut to being well-informed, maybe spark some new questions for your own explorations. Until next time, keep learning and keep digging deeper.